Hi, I'm Dongxiang. Welcome to Dig Into China, where we take a deeper look at China to review insights you can rarely find anywhere else. Today, let's revisit the topic of the CCP's financial easing. At the end of October, China's central bank added a new tool to its monetary policy arsenal called buyout reverse repurchase agreement. This year, the People's Bank of China has been notably active, selling government bonds, conducting indirect stock purchases, and now introducing this buyout-style reverse purchase agreement. What is this buyout reverse purchase agreement all about? Let me break it down in simple terms. A reverse purchase agreement is a tool that the central bank uses for financial easing. In this arrangement, financial institutions, mainly commercial banks, can pledge their bonds to the central bank in exchange for cash. The traditional method involves a 7-day reverse repurchase agreement, where the central bank lends you money for just 7 days using the bond as collateral. After 7 days, you redeem your bonds and pay back the central bank. During this time, the bonds are only pledged to the central bank and cannot be sold, as the bank remains the owner. This situation is similar to mortgage a house. Until you pay off the loan, you can't sell the house. It's essentially frozen, but the title is still in your name, meaning the house is yours and not the bank's. Under the central bank's new approach to the buyout reverse repurchase agreement, banks no longer just pledge their bonds. Instead, they sell the bonds directly to the central bank, agreeing to buy them back after a year. This means the bonds are not in a frozen state anymore, allowing the central bank to manage them freely. With the buyout, ownership is completely transferred to the central bank, which now holds the bonds. The central bank's only obligation is to ensure it has the bonds available to return to the banks at the end of the year. It's like mortgaging a house. Previously, the title would remain in my name even while it was mortgaged, but now the title would change to the bank's name. This allows the bank to sell the house at will. However, as long as I repay the loan, the bank must buy the house back and return to me. If the bank decides to sell the house during the loan period to make a profit, that's their decision. Still, there are significant transaction costs involved, and if the house is sold, the bank might find it difficult to buy it back if the new owner isn't willing to sell. This situation could lead to the bank defaulting on its obligations. However, the bonds held by the central bank have high liquidity, allowing for frequent trading. This effectively increases the number of bonds available for trading in the central bank's portfolio. With a larger bond inventory, the central bank can potentially influence the market to raise yields. Thus, the buyout reverse repurchase agreement has multiple benefits. It expands the tools for financial easing and bolsters central bank's bond holdings, enabling it to more easily intervene in the market and counteract the bullish sentiment. Regarding financial easing, it's essential to delve into how the People's Bank of China conducts its operations. While many are familiar with the term financial easing, its true meaning may not be well understood. The central bank's approach to easing has distinct characteristics that we need to explore within a historical framework. The term financial easing is a common way to describe the process, but more precisely, it refers to the central bank's action of injecting base money into the economy. It's crucial to recognize that the central bank provides base money, which then transforms into what we refer to M2 through the lending activities of commercial banks. Let's illustrate this with an example. If the central bank injects 100 million yuan of base money into the Industrial and Commercial Bank of China, ICBC, and ICBC then loans this 100 million yuan to China National Petroleum Corporation, CNPC, the situation unfolds as follows. Once CNPC receives the funds, it immediately repays the loan, sending the money back to ICBC. In this case, the money multiplier is 1, meaning that 100 million of base money has only resulted in 100 million yuan of M2. This represents the worst case scenario, commonly referred to as a failure of monetary policy, where funds circulate within the financial system without generating any meaningful economic activity. In a more favorable scenario, ICBC would initially lend 100 million yuan to John. John would then deposit it back to the bank. ICBC could then lend the same amount to Mary, who would also deposit it back, allowing ICBC to loan again to David. Taking into account the reserve requirement ratio, how many times can ICBC lend this amount? The answer is the reciprocal of the reserve requirement ratio, which represents the maximum money multiplier. For instance, with a deposit reserve ratio of 8% at ICBC, the maximum money multiplier is 12.5. This indicates that ICBC can lend out funds up to 12.5 times. Thus, 100 million in base currency can convert into 1.25 billion in M2, showcasing the economy's optimal performance, which would certainly delight the central bank. Do you know what the current money multiplier in China is? It's quite simple to calculate. The term reserve money on the central bank's balance sheet reflects the balance of base money, which stood at 38 trillion yuan at the end of September. At the same time, the M2 balance was 309.48 trillion yuan, leading to a calculated money multiplier of 8.16. Currently, commercial banks have an average reserve requirement ratio of 6.6%, meaning the theoretical maximum money multiplier is 15. Considering that 8 is still quite a distance from 15, this explains the weak demand for credit in the market, something we can quantify. Let's make a comparison with 2018, prior to the pandemic. Back then, the reserve requirement ratio in the financial system reaches 14.9%, and the theoretical maximum money multiplier was only 6.7. In contrast, the money multiplier we derived from the central bank's balance sheet was 5.5. So which one is closer, 5.5 to 6.7 or 8.16 to 15? It's evident that domestic credit demand is on the decline and the banks are facing difficulties in issuing loans. As a result, the central bank is feeling the pressure. If it wants to keep increasing M2, it must inject more base money. Initially, the central bank thought that injecting 100 million of base money would boost M2 to 1.5 billion yuan. But the reality is that this amount can only generate 800 million yuan of M2. And therefore, to achieve 1.5 billion yuan in M2, the central bank would need to inject nearly double the amount of base money. The central bank is obligated to boost M2 since it is essential for GDP. If there is a required GDP target to meet, the central bank must inject more base money, even as the money multiplier declines. This is the current challenge for China's central bank. It does not operate independently and is tasked with the mission of increasing M2. However, money cannot be printed recklessly, which raises the issue of anchoring. Looking back at history, after China joined the WTO in 2001, there was a surplus in both trade and capital, resulting in a large influx of dollars into the country. At that time, the central bank issued base money anchored to the dollar for currency settlement. Since the economy was growing and the influx of dollars was significant, the central bank became concerned about the possibility of excessive money printing leading to high inflation. To counter this, the central bank implemented measures like issuing central bank bills and increasing the reserve requirement ratio to withdraw some of the printed money from circulation. However, following the stock market crash in 2015, there was a significant outflow of foreign exchange, leading to a loss of $1 trillion in foreign reserves within a year. If the central bank had maintained its dollar-anchored money printing approach during this period, the depletion of foreign reserve and the capital flight would have reduced its foreign assets. This would necessitate a reduction in the yuan supply through measures like raising the reserve requirement ratio to stabilize the exchange rate. However, implementing such measures at that time could have worsened economic deflation and potentially triggered a financial crisis. What was the solution? Beginning in 2015, the central bank moved away from using the dollar as its sole anchor for money printing. Instead, it developed a range of monetary policy tools to inject base money into the economy, such as MLF, Medium-Term Lending Facility, SLF, Standing Lending Facility, and a 7-day reverse repos. What are these tools anchored to? Essentially, they are linked to credit bonds. The central bank's balance sheet clearly indicates that the foreign exchange and the claims on other deposit-taking institutions are the anchors for issuing base money. Through comparison, we can observe that the central bank currently relies on foreign exchange as half of its anchor for money printing, with credit bonds making up the other half. This year, the central bank has introduced some reforms related to this anchor for monetary easing. For example, we can expect to see stocks on the central bank's balance sheet because it has launched a new swap facility. Additionally, there will likely be an increase in government bonds due to the central bank's initiation of secondary market trading of these bonds. Consequently, the structure of the central bank's balance sheet will evolve, featuring more government bonds, more stocks, and fewer reserve deposits. As long as monetary easing continues, the significance of the foreign exchange anchor will diminish further. When discussing monetary easing, we often assume that the more money the central bank injects, the higher inflation will be. However, this assumption is not entirely accurate. For example, if the central bank injects 100 million of base money into ICBC, which then lends it to CMPC to repay a loan, the money multiplier effectively remains 1, meaning the funds simply circulate within the banking system. In this scenario, how can prices increase? Thus, a key condition is that inflation will only arise when the money injected by the central bank flows into the real economy. The Chinese central bank's monetary easing will unfold in 3 stages, and only in the final stage will hyperinflation occur in China. This is a vital point to consider. The first stage involves debt repayment. During this phase, the central bank injects money to provide funding to local governments and state-owned enterprises so they can pay off their debts. For instance, the Communist Party is currently replacing local hidden debts with government bonds, which are mainly acquired by financial institutions, with the central bank providing liquidity support behind the scenes. This entire process leads to the central bank injecting money and the local governments and the state-owned enterprises repaying debts. But the funds do not circulate into the real economy. The second stage focuses on meeting GDP targets. In this phase, the central bank directs its monetary easing towards state-owned enterprises, central enterprises, publicly listed companies, and the large private firms. For instance, the central bank has introduced specific refinancing tools for affordable housing projects, encouraging commercial banks to lend to local government initiatives in this area. Many of these projects are designed to achieve GDP goals, meaning some funds will indeed flow into the real economy, even if the government constructs an unnecessary airport or dock. It still needs to hire workers, pay salaries, and purchase materials, allowing some money to circulate. However, a significant portion of this money ultimately ends up in the hands of interest groups. It may either be concealed as cash in the homes of corrupted officials or enter capital markets, transforming into shares that can later be liquidated. This stage is unlikely to cause high inflation, as the funds entering the real economy are still too limited. Instead, we may see the emergence of structural asset bubbles in capital markets, with stock prices for a handful of large companies experiencing substantial increases. For example, the central bank's current stock repurchase and refinancing initiatives can contribute to this effect. In the final stage, as the central bank continues to inject liquidity, the significance of foreign exchange as an anchor diminishes, resulting in imported inflation. The reasoning is quite simple. When the supply of renminbi increases while demand remains stagnant, the exchange rate must decline. As the exchange rate falls, foreign capital starts to flee, leading to imported inflation. This form of inflation is especially harmful, as it causes substantial rises in the prices of imported goods and the raw materials, which directly increases the cost of production and essential living expenses. When people see the renminbi's exchange rate continually falling while the prices of essential goods like grains and oils rise, they often panic and rush to stockpile food, which can lead to hyperinflation. Thus, while excessive money supply can ultimately result in hyperinflation, China is currently in the first and second stage, where very little money is entering the real economy. This makes it difficult to induce widespread high inflation. Instead, we are more likely to witness structural asset bubbles, such as substantial increases in the prices of certain stocks. Honestly, the central bank's mission should not be limited to just achieving GDP targets. Its primary responsibility should include three key areas: controlling inflation, ensuring employment, and maintaining financial stability, which encompasses stabilizing exchange rate and preventing financial crisis. Ideally, boosting GDP should not be the central bank's main priority. However, because the People's Bank of China lacks independence, it seems to focus solely on GDP, with all its actions aimed at promoting growth. This is a significant concern. I believe this is a key reason why China is at the risk of hyperinflation. If China continues to cling to this facade of GDP growth, the future may result in the renminbi becoming worthless. Thank you so much for watching. If you find this video helpful, please like it, drop a comment below, and hit the subscribe button right here. It really helps YouTube suggest my video to others. I'll be back with more content soon. Until then, be well.